Welcome to the CFA Level 1 Practice Test 1. Domain, derivatives. A pure arbitrage opportunity is best described as a transaction that A. Offers a potential for high returns by taking on substantial risk. B. Requires a net investment to exploit mispricing between two equivalent assets. C. Provides a certain profit with no net investment of capital and without bearing any risk. D. None of the above. Answer is C. Provides a certain profit with no net investment of capital and without bearing any risk. A company considers a project that includes a provision allowing it to discontinue operations and sell assets if conditions deteriorate. What type of real option is this? A. A timing option. B. A growth option. C. An abandonment option. D. None of the above. Answer is C. An abandonment option allows discontinuing a project and selling assets if conditions are unfavorable. Which of the following is least likely a contribution of derivative markets to a financial system? A. Improving the discovery of market prices. B. Facilitating more efficient risk allocation. C. Guaranteeing the reduction of overall market volatility. D. Not applicable. Answer is C. Derivatives do not guarantee reduced market volatility and may sometimes increase it. What is a key difference in credit risk exposure between forward and futures contracts? A. Forward contracts have no credit risk due to daily settlement. Futures contracts have significant credit risk. B. Futures contracts expose parties to credit risk. Forward contracts use a central clearinghouse. C. Forward contracts entail credit risk for parties. Futures contracts mitigate risk via a central clearinghouse. D. None of the above. Answer is C. Forward contracts expose each party to credit risk. Futures contracts mitigate this risk through a central clearinghouse. A project includes potential to invest later to double capacity if sales are strong. This feature is best described as A. A growth option. B. A timing option. C. An abandonment option. D. None of the above. Answer is A. The ability to expand capacity if successful is a growth option. Which best describes a pure arbitrage opportunity? A. It involves significant market risk. B. It needs a large upfront capital outlay. C. It guarantees a profit without any initial net capital. D. None of the above. Answer is C. Arbitrage guarantees profit with no initial net investment or risk. Which statement accurately describes a pure arbitrage transaction? A. Involves significant risk for potential high reward. B. Requires initial capital to secure certain profit. C. Provides risk-free profit without net capital investment at start. D. Not applicable. Answer is C. Arbitrage involves zero net capital investment and no risk with guaranteed profits. What key characteristic distinguishes futures contracts from forward contracts? A. Subject to greater counterparty risk. B. Customized to meet user needs. C. Standardized and traded on an organized exchange. D. None of the above. Answer is C. Futures contracts are standardized and traded on organized exchanges, unlike customizable forward contracts. Which is least likely a primary contribution of derivative markets to financial system efficiency? A. Ensuring all participants achieve above-average returns. B. Providing signals about future price movements of underlying assets. C. Facilitating more precise risk allocation. D. None of the above. Answer is A. Derivatives do not guarantee above-average returns for participants. A transaction exploiting mispricing between a derivative and its underlying to secure a risk-free profit is called A. Hedging. B. Arbitrage. C. Speculation. D. Not applicable. Answer is B. Arbitrage exploits price differences to achieve risk-free profit. Thank you for watching. For more learning videos and tutorials, subscribe to BSP Trainings.